Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss Powell signals a change in Fed policy. We're also going to take a look at land, labor, capital, and productivity, as well as OBBB, Charitable Deductions 2025 and beyond, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are you, good sir?
Things are good. You know, summer's kind of coming to a close, but football season's here, and my Nebraska Cornhuskers are 1-0 to start the season. So that's we're optimistic.
Yeah. Well, wait, clarify for me. Are they in the same division as Alabama?
No, they're in the Big Ten, so they're with Ohio State, Oregon, those powerhouses.
Okay, yeah, I couldn't remember because I saw Alabama didn't get off to a good start, and obviously Sabian being gone, makes it interesting. And speaking of football, my youngest and I, as you know, an avid Niners fan, so we got out for the good preseason action against the Chargers, which they got the W, so that was pretty cool to go and have that time. So excited for that Niners season. Hopefully we're gonna got a team that'll be playoff bound, if not returning to the Super Bowl.
That's right. Stay injury free, and we'll be all right.
Yes, sir. All right. Well, let's jump into Powell signals a change in Fed policy. The long awaited. It's been interesting. And the Federal Reserve Chairman Jerome Powell gave an annual Fed chair speech at the Jackson Hole Economic Symposium on the 22nd. It's been anticipated. What do we see around Federal Reserve policy, the path for the second half of 2025, and looking forward?
Yeah, so I mean, some background, right? So obviously we went through a bout of high inflation out of COVID. I would argue the Fed was maybe slow to act in raising interest rates to try and tame inflation. But finally, once they got moving, they increased rates pretty quickly and consistently until inflation started to come down. And then, fall of last year, they said, okay, our monetary policy has been tight enough. Inflation's trending down. We want to make sure the economy continues to grow, job market stays strong as a part of their dual mandate. So they started lowering interest rates through the fall. Then this year, 2025, they basically paused, citing, uncertainty around tariffs and how, the effect that may have on inflation. But we haven't really seen that, flow through to the actual data. So it's, becoming more and more expected that they would resume their policy of lowering interest rates, but it hasn't happened yet. We've got, the meeting coming up here in September pretty soon. So this speech that Chair Powell gave at the Jackson Hole Economic Symposium on August 22nd was, a big focus because it's usually a place where the chairman goes into detail and really talks about the Fed position and kind of forecasts what they may be looking at for the next 6 months to a year. And this talk didn't disappoint from that standpoint.
Yeah. What were some of the areas that he touched on? I mean, let's start like labor market, an important area of discussion. What have we seen there? Because we do touch on the employment rate and unemployment rate frequently.
Yeah, it was kind of interesting, the interpretation. So he started by pointing out something that we've talked about, which was, the large revision to the job gains that we had last month, right? So, making it look like the economy is not creating as many jobs as maybe we previously thought, but also that the unemployment rate only ticked up slightly, right? That we didn't see a big change there. And in essence, their, thought is that in essence, what we're seeing is at the same time a decrease in job demand from employers and also a decrease in labor supply as you have reduced immigration and workers leaving the labor force. So Basically the job market is remaining in balance or in equilibrium because both supply and demand have decreased to some extent. The Fed would still interpret that as a sign of the labor market slowing a bit. And given their dual mandate to maintain price stability, in other words, low inflation and full employment, right, to keep the economy growing at a point where the job market remains strong. So that kind of hinted towards, the Fed lowering interest rates. Then on the inflation front, they still expect the implementation of tariffs to create a one-time increase in the price of goods that are imported from abroad. Now, their big question or their big challenge is, will this just be a short-term shock to the system and then it'll kind of just, work its way through? Or will it create a downward trend in other categories such as housing, as that overall inflationary impact takes hold? But really, the Fed's biggest concern is creating an inflationary cycle, where if there's a one-time increase in prices, it creates an expectation. Maybe you have workers see their purchasing power reduce, so they demand higher wages, which means then businesses have to raise their prices to be able to pay those higher wages, and you get this ongoing cycle. But they point out, given the perceived weakness in the labor market, and the reduced demand for workers, maybe it's unlikely that workers will have the bargaining power to be able to demand those pay increases. So potentially it reduces the risk of this inflationary cycle taking place. And then even if a one-time adjustment in prices does materialize, it may just be a one-time shock as opposed to something that, becomes an ongoing trend.
Yeah, I've found this section real interesting, or at least leading to a lot of questions for me. When I read the part about both job demand and labor supply, it makes me wonder, when it comes to employers looking for new hiring, is it because how not only inflation rates but the interest rates play into it, that maybe organizations are not looking to expand because it's just too risky maybe to take that loan at this time? They don't have the capital for it, so they're just not looking to fill additional positions because, as you know, as an employer, you take on somebody else. It's not just the paycheck that you're paying the employee. There's so many other things that go into it, your insurance costs, et cetera, et cetera. So is there just around that lack of employers seeking new employees? What are the factors that go into play?
Yeah, I mean, that's the challenge for the Fed. They have one tool, right? And it's interest rates. And, everything you just said to a greater or lesser extent is true, right? And everything else being equal, right? As we often say in economics, holding every other variable constant. Of course, in the real world, every other variable is not held constant. It's potentially changing because of changes in policy, or it's just changing because of other factors. Right? Mm-hmm. And so you could be in a situation where the Fed could lower interest rates and it doesn't necessarily create higher economic growth or employment because you have these other mitigating factors that are offsetting that. But in general, given the tools that the Fed has available, that would be the reasonable step, that they would think lowering interest rates will lead to, faster pace of economic growth, which will lead to a stronger labor market. And so, with the weakening that they're seeing in the labor market, and Chairman Powell did, basically say they do view the current interest rate as somewhat restrictive, meaning higher than their neutral rate. So in other words, they're more focusing on taming inflation than maintaining, strong growth in the labor market. But given the uncertainty in both the labor market and the inflation situation, basically hinting that it may be better to move the rate to somewhat closer to what they consider that neutral rate. And so if they're saying that it's above the neutral rate now, moving it closer to the neutral rate, is basically in Fed speak, which you always have to interpret, in essence is hinting at lower interest rates in their September meeting.
Yeah, no, very, very interesting. Yeah, the more, we've done this podcast for over a decade now, and I'm always learning something new, even though it seems simple from the surface in some aspects. But like you said, this is the only tool that they have is that movement of the interest rate around that. There's really nothing else they have access to maybe stimulate that lowering of inflation or employers to seek adding to their job force and their labor force.
Well, they have the target federal funds rate. They've engaged in quantitative easing at times during big financial crises and things like that. But really, they're pretty good at staying in their lane and saying anything else is the purview of Congress, right? They know that they don't want to step in and be the overall manager of the financial system. They have to partner with the Treasury, but at the same time be independent of what Congress is doing and what the Treasury is doing. So yeah, they have limited flexibility as well in terms of the tools that are at their disposal. And I think one of the most interesting things is kind of looking forward. Okay, so that answered one of the market's questions. Rates are probably going to be coming down this fall. The stock market responded positively, right? That was viewed as a good thing. But Powell also warned that the pre-pandemic super low interest rates that we got used to for such a long time there are probably a thing of the past. There's probably structurally higher inflation and other factors that would keep the neutral level of interest rates higher than they were before 2020. And at the same time, said the Fed is still committed to their 2% inflation target over the long term. So basically, if they see any sign that inflation is starting to get out of hand, they will err on the side of bringing inflation down, even if that means the economy will be operating at a level below full employment. But I think that's the typical job of a central bank to say, look, we're not going to let inflation get out of hand. Businesses and investors need kind of that long-term stability of where price points will be. So it makes sense that would be like the parting comments.
Yeah. And what did he reference? I know he made a reference to not engaging in policy mistakes that have led to major challenges in other countries. Is there any more specificity you could lend to that?
Yeah, I mean, basically, he's pointing to what we've seen in some South American, African countries where they put such a priority over economic growth and full employment that they let inflation run wild. And clearly that has not worked, right? I mean, Argentina is probably the best example until recently. They were averaging 100% inflation a year. And because everything was about, we need to keep people employed, we need to, create, whatever growth and opportunities that we can, but they're doing it at the sacrificing the long-term financial stability of the country. And it really hasn't worked out well. So he's making it clear that actually their goal will be to keep inflation down. And even if that means, a rough job market in the short term, they will do that because they think it'll be better overall for the country in the long term.
Yeah. No, thank you for clarification on that. Anything else you want to add before we jump to land, labor, capital, and productivity?
Well, just I think the next thing will be the statement that comes out of the September meeting, right? That'll be interesting to see how that vote goes, but also how the statement may change for some clarity as to what we might see, through the remainder of the year.
All right. Well, let's dive on over to land, labor, capital, and productivity. One of the macroeconomic theories of economic growth is that growth boils down to the inputs of the available land, labor, capital, investment, and productivity, technological advancements. So what are we seeing in the modern economic landscape around this? I mean, this has been a kind of an interesting amalgam of things we've discussed over the last 3 to 4 months here, really.
Right. Yeah. And we try to mix it up, right? We just focused on, one event, short term, right? What's going on in the market. And this is an opportunity to really kind of zoom out and say, where is economic growth in the U.S. likely to come from? If you look at those 4 inputs, you can kind of narrow it down and say, okay, land in the current economy, information-based economy is generally not as valuable, right? And an agrarian economy where everybody's farming, it's land inputs are really important. But for the most part in the U.S., there's plenty of land and plenty of opportunity to expand, but it's less of a valuable input. Then you shift over and you say, Okay, well, what about labor? Well, labor is probably the easiest place to grow. If you have a high population growth, those people are probably going to find a place to, to do something productive, because obviously they gotta, find food, shelter, clothing, that type of thing, even for the basics. Although, labor typically isn't the way that you increase someone's standard of living, right? You can have a very fast growing population that causes the economy to grow, but that doesn't mean those people are getting wealthier. It could just mean that, they're all at kind of a subsistence level. And you're just adding more people at a subsistence level, which means you're producing more, but are you really getting richer, at least per capita basis? And of course, looking at the U.S., labor could become a challenge, right? Because, with immigration down and deportations and things like that, obviously that's going to reduce the labor supply. And then the fact that the birth rates among native-born Americans continues to be at a rate below replacement. So basically, you could argue the labor force is likely to be stagnant or possibly even shrinking. So it's unlikely to be a big contributor to overall economic growth for the country. Then you have capital. That's an important input, basically investments made for the future. But as we just talked about, higher interest rates, have limited growth in some sectors of the economy. The capital markets are still really, really strong for equity investments, right? Money invested in new startups where, the investors are taking a stake in the company and hoping that it really grows and pays off in the long run. But any areas of the economy that are really dependent on the debt markets, we've seen pretty slow growth. I mean, real estate being a great example, right? Typically, a big part of any real estate deal is debt. And so with interest rates being high, that's likely to slow the impact that capital will have on economic growth. So all that being said, it boils down to the last one, which is productivity, right? Basically being able to do more with less, or each person, maximizing the value of your labor by allowing them to use the tools, often some form of technological advancement, to be able to produce more. And that's where I think, it's really interesting that clearly that's where the focus needs to be if we're going to maintain a high level of economic growth.
Yeah, I know me personally with the work that I do. I've started to utilize all these different tools that weren't readily available before, especially in the AI space that maybe I might have outsourced a little bit or were incredibly time consuming. So it is interesting how that revision continues to come. And I even have to examine my skill sets and looking at going back with some levels of continual education in certain ways. So it is an interesting area to see where is that going to go and what is going to result from that, which of course it's not an overnight situation.
Yeah, no, I think that's the key. And that's why we've seen so much excitement and so much investment going into artificial intelligence, right? That promise of potential productivity. We saw a big boom in productivity in the 90s as we moved more into the computer age, and especially the internet, and that connectivity really took off. And that was a big part of the strong growth we had in the 90s. It was a period where you did see standard of living really across the board increase. And so, that's the ideal way you want to grow, by increases in productivity. And at this point, with the country being constrained to a degree in labor and capital, that productivity growth, whether it comes from AI or some type of similar technology, is going to be so much more important going forward.
All right, well, let's dive in. The one big beautiful bill enacted on July 4th, 2025. Charitable deductions. How are they? What changes are happening for 2025 and beyond?
Yeah, we're getting down to some of the smaller changes in the bill here, but it will, positively impact, some clients, some taxpayers on a certain scale. But so beginning in 2026, so not this year, but we're looking forward to next year. People who don't itemize their deductions will be able to claim up to $1,000 if they file a single, or $2,000 for married filing joint, as a charitable deduction without having to itemize.
Mm.
So this was something that came out of the original 2017 tax cut bill, where they increased the standard deduction, so less people were going to be itemizing, therefore less people were going to benefit from charitable deductions. And to try and smooth out the impact to charities, I think they had a $300 per person deduction that you could claim. So obviously this has been expanded to $1,000, where people may still be able to, if they give a little bit to charity each year, still be able to get some benefit without, having to have other itemized deductions that would cause them to exceed the standard deduction.
Well, what about for folks that go above that 1,000 as an individual or 2,000 as a married filing joint?
Well, if they're still claiming the standard deduction, then they're really not going to get any benefit from it, at least from a tax standpoint. If it's large enough, they may be able to itemize their deductions, right? That may add up to enough where they would get some benefit. Or, as we've talked about in past podcasts, there's a number of other strategies that they may be able to utilize to get some benefit from those charitable deductions, especially if it's getting into the larger amounts.
What about 2026? What is going into effect around that?
Yeah, so just like they created this new system where you can, deduct the first dollars, they also created a system where they're basically taking away some of those first dollars for higher income taxpayers. So if taxpayers, have higher income, they'll only be able to claim a deduction to the extent that it exceeds 0.5% of their income. It would have to be greater than that. So, as an example, let's say you have a taxpayer with adjusted gross income of 200,000. They can only deduct their charitable contributions that exceed $1,000 or 0.5%. So when they itemize. So, if they give $10,000 to charity, they'd only be able to deduct $9,000. That first $1,000 is taken away. So it's kind of on the one side, certain taxpayers that don't itemize, the first $1,000 is given to them. On the other side, higher income taxpayers, in this case, that first $1,000 is taken away. So it is going to make it a little more tricky, to look at those charitable contributions and what's the best strategy.
Right. Well, and what's the recommendation for anyone that makes continual charitable donations?
Well, I mean, they may have the opportunity to do qualified charitable distributions if they're over age 70 and a half and have retirement accounts. They may benefit from front loading those contributions by putting it into a donor advised fund. It also may make sense if they have appreciated stock to use that as a funding vehicle. There's just a lot of different ins and outs. It's basically the planning for charitable contributions in terms of being able to get the best tax benefit has become a lot more complicated.
Yeah, sure sounds like it. And as recommended here in the personal financial review, keep good records of your donations, right? That way it's going to allow whomever's doing your taxes to best assess what the plan of action is.
That's right. Absolutely. That's always important.
Yes, sir. All right, let's jump on over to the Plan Solutions Incorporated office bulletin board. We are right around the corner from the Harlan D. Wood and Debbie Dravenga Memorial Cancer Charity Golf Tournament.
That's right. Deadline's coming up. We still have some spots available. Friday, October 10th. It'll be a 1 p.m. shotgun. There'll be a boxed lunch and then a reception with some heavy hors d'oeuvres and things afterwards. Trying to kind of shorten up the after round festivities, keep it short and sweet. But it'll be Rancho Marietta Country Club, North Course. They always do a great job. So yeah, putting a call out there to anyone who hasn't signed up, now's the time. Anyone who wants to donate to a cancer charity, to help support the tournament, we'd appreciate that as well.
Yes, sir. Absolutely. And it is a beautiful course. I have played both of them with you and very much enjoyed it and looking forward to this event. And if someone does want to sign up, best way to do it, just call the office or send an email.
Absolutely. Yeah. Call the office, talk to Caitlin, or you can, email Katie at Plant Solutions as you have in the podcast, and she'll make sure they get registered.
All right. Thank you, good sir. And thank you for listening to the Plan Solutions Incorporated podcast, either Apple Podcast, Spotify. Please hit follow there if this is your first time. And please share with someone else that you think will get value out of the podcast. And if you'd prefer to follow along to a visual form of the podcast, we do have a YouTube channel. It's youtube.com/@plansolutions. And you'll hear this conversation as well as see the personal financial review on screen as we discuss the various topics. And if you have yet to subscribe to the Personal Financial Review, it's simple. Just send Katie an email. That's KATIE @plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.